Introduction to equity funds. Equity funds, also known as stock funds, are investment funds that primarily hold stocks or shares of publicly traded companies. These funds offer investors the opportunity to participate in the growth potential of the stock market by pooling their money with other investors. Equity funds are managed by professional fund managers who make investment decisions based on the fund's investment objectives and the performance of individual stocks. Understanding the basics of equity funds. Equity funds can be broadly categorized into various types, such as index funds, actively managed funds, sector funds, and international funds. Index funds aim to replicate the performance of a specific stock market index, such as the S&P 500, by holding a diversified portfolio of stocks that mirror the index's composition. Actively managed funds, on the other hand, involve fund managers making investment decisions to outperform the market or achieve specific investment goals. Benefits of investing in equity funds. Investing in equity funds offers several advantages for beginners. Firstly, equity funds provide diversification, allowing investors to spread their investments across a broad range of stocks, which can help reduce the impact of individual stock volatility on the overall portfolio. Additionally, equity funds provide access to professional fund management, enabling investors to benefit from the expertise of seasoned investment professionals. Furthermore, equity funds offer liquidity, as investors can buy or sell fund shares on any business day. Risks associated with equity funds. While equity funds offer the potential for long-term growth, they also carry certain risks. Market risk, which refers to the possibility of stock prices declining due to broader economic or market-related factors, is a primary risk associated with equity funds. Sector-specific risks, such as the performance of a particular industry or sector, can also impact the value of equity funds. Additionally, individual stock risk and currency risk for international funds are important considerations for investors. Selecting the right equity fund. Choosing the right equity fund requires careful consideration of various factors. Investors should assess the fund's investment objective, risk profile, historical performance, and expense ratio. The expense ratio represents the annual operating expenses of the fund as a percentage of its average net assets. Lower expense ratios can contribute to higher returns for investors over time. Additionally, investors should evaluate the fund manager's track record and investment philosophy to ensure alignment with their own investment goals. Long-term perspective and investment strategy. Investing in equity funds requires a long-term perspective and a disciplined investment strategy. Historically, the stock market has demonstrated the potential for long-term growth, and equity funds can play a key role in building wealth over time. By adopting a buy-and-hold approach, investors can ride out short-term market fluctuations and benefit from the compounding effect of long-term returns. Equity funds and asset allocation. Equity funds are an essential component of a well-diversified investment portfolio. Asset allocation, which involves dividing investments across different asset classes, such as stocks, bonds, and cash equivalents, is crucial for managing risk and achieving investment objectives. Equity funds can provide the growth potential necessary to meet long-term financial goals, while other asset classes can offer stability and income. Tax considerations and investment planning. Investors should also consider the tax implications of investing in equity funds. Capital gains taxes apply to the profits realized from selling fund shares, and dividends distributed by equity funds are subject to taxation. Tax-efficient investment strategies, such as holding funds in tax-advantaged accounts like individual retirement accounts (IRAs) or 401k plans, can help minimize tax liabilities and enhance overall investment returns. Conclusion: building wealth through equity funds. In conclusion, investing in equity funds presents an opportunity for beginners to participate in the growth potential of the stock market, while benefiting from professional fund management and diversification. By understanding the basics of equity funds, assessing the associated risks, and selecting the right funds aligned with their investment goals, beginners can embark on a path toward long-term wealth accumulation. Equity funds, when integrated into a well-structured investment plan, can serve as a powerful tool for achieving financial success and building a resilient investment portfolio.